What are some of the other items reported in retained earnings? And what is retained earnings? Well, the statement of retained earnings is just showing the cumulative amount of net income less any losses or dividends declared since the company started. So that's the whole concept of retained earnings. It's like how much earnings have we retained through the beginning of our operations. Most states restrict the amount of treasury stock purchases to the amount of retained earnings. There's legal restrictions to it. You can't buy back your own stock if you don't have any retained earnings. And there's contractual restrictions. A lot of times loan agreements won't allow retained earnings to dip below a certain level, or won't allow you to pay dividends if you have negative retained earnings, like we talked about earlier. So let's talk about some corrections, right? Retained earnings, this leads to an interesting issue, where retained earnings is a balance sheet account. So it carries over year after year after year. What happens if we find out that we made a mistake in one of our accounting entries? Well, that means that it's going to change all of our entries, right? It's not as simple as if we have a mistake in our revenue or expense this year, that washes every year, right? Like we make a new profit and loss statement for yearly. But if it's in our balance sheet, we have to make an entire fluctuation of differences, because that earnings amount also changes our tax amount. It also changes our interest amounts potentially. It changes what our balance sheet would tie out to. It changes our assets. It changes everything. And so what happens if we make a mistake in our retained earnings? We might have to do prior period adjustments. And so we might have to put in the current period. We might list that as a prior period adjustment, or if it's bad enough, we might have to restate the prior period, the prior financial statements. So depending on the amount, we will decide if we need to restate the prior period financials, if we want to disclose the error. And you'll learn about those thresholds in future classes. And so ultimately, we've talked about the statement of retained earnings a lot, the book has. I've talked more about the statement of stockholders' equity. That's really what we prepare. There's no really statement of retained earnings unless you are doing a very small business, like under $100,000 of revenue. Really, stockholders' equity is what we're talking about because it's more complex, right? We normally have common stock that we have to reconcile every year. We want to see the differences of what happened. It's an important statement. We want to see what happened every single year. So we'll talk about how the common stock changed. What's the dollar value of the common stock at par and at paid in capital in excess of par. Talk about how retained earnings changed. If there's any other adjustments. What about preferred stock? What about, we're learning about a lot more components of equity, how people can raise money through equity, right? And then this will reconcile every year. Generally, you see a lot more transactions, more than just 1 year. So we could see that here. It showed all the way back to 2018. You can see for Apple how the common stock balances grew and changed. We had beginning balance of $35,000 of stock. We issued $669 of stock. We settled equity rewards. We gave equity rewards of $1,778, or people paid them the net share settlement. And then we also paid our employees an extra $5,000 of stock. How our retained earnings changed through dividends. And you see that for the last 3 years in the financial statement, right? That's useful information for anyone who wants to buy Apple. So you can see the statement of retained earnings is actually rather complex here, right? There's a lot of information here. So one of the last pieces we're going to talk about, and I think one of the most important pieces of this class, is earnings per share. Why is this important? Anyone who's bought a stock, or if you ever buy stocks in the future, you're going to hear about earnings season. If you listen to anything I recommend listen to Marketplace on the radio. NPR has a show, or listen to some investing forums. It's usually useful for your business, or just read the news. They talk about earnings releases every quarter. It's happening right now, the quarterly earning releases. It drives the whole market. Right? Everyone's excited about late April, early May, when you learn about how companies are doing, because it reflects the economy. And those earnings releases are based off of this number, earnings per share. How well are companies doing is measured by how much earnings they're making per share. How many dollar values are they? What's the dollar value that can be prescribed to the shareholders' value, right? So what's the income per share? This is actually a complex number, and a lot of people don't understand it. But being an accountant and learning about this, you'll learn about the complexity, and you'll actually understand what this number means. You need to memorize this. basic earnings per share is the net income minus preferred dividends over the weighted average common shares outstanding. What does this mean? We determine as shares are being issued, shares get issued out throughout the year, right? Either through stock-based compensation, where employees get shares, or people might be issued, or investors might buy more shares. We take the weighted average common shares outstanding over the period to figure out an average amount, and then take our income, but we have to subtract out any preferred dividends in order to find our basic earnings per share. So it's not as easy as just taking income divided by the last amount of shares, right? This is actually a very complex equation. I'll give it to you in your homework and tests, right? I'm just going to say this is the weighted average common shares outstanding. In practice, this is a very complicated number, right? Because a company might issue shares 10 to 100 times throughout a year. If they have, or they might do, most best practices like 12 times. They might do it monthly. Every time they have new employees hired, they might give them some shares. And so figuring out how to average out those shares, then figuring out what the preferred dividend amount and subtracting that is complex. Not only that, there's also a number that has to be reported called diluted earnings per share. You're not going to learn about how to calculate that in this class. That is used if what happens if there's stock options available, and what happens at any given time, all of those employees were to execute those stock options, it would dilute the value of those earnings to the people, the current shareholders. And so you'll learn about that in the future. And both of those drive the valuation of the company, what people are willing to pay for it in today's marketplace, which then ultimately drives how the economy is at least perceived, right? The economy is different than the market, but if the market does well, it's perceived that the economy is doing somewhat well. So this is a very important metric. Make sure you memorize it. All of these will be given to you. I'm not going to ask you to calculate the weighted average, but no, it is a complex number, and you'll learn about it if you continue your accounting education. Okay, compute price earnings ratio. So once we figure out the the earnings per share, then you can figure out the price earnings ratio. And this is how a lot of people invest. It's a way to do value investing. It's how much a share is worth versus their earnings per share. And you can see it as a top metric for any investment. So if I want to compare Microsoft stock, I'll get a price earnings ratio here. That's what the PE ratio is. It's the price of the share currently, 261.15, divided by the earnings per share, which we calculated previously. So you can back into the earnings per share. And that's the earnings per share in the last calculation. So they're trading at a 38.9. So it means that you're paying 39 times the value of what their current earnings are. That's what you're paying for Microsoft. So a good way to compare investments is if Microsoft is paying this, and then we look at Google stock, maybe we say their competitor, Google stock is trading at 36. We'd say Microsoft is more expensive than Google. If we believe that Google would be more valuable than Microsoft, we'd say there's a pricing discrepancy and we'd want to invest in Google, right? Because there should be equal price, but we'd have to make those determinations. That's a type of value investing. You can do the same with like Target versus Walmart if you'd want to say they're competitors. Target stock, Target's traded at $23 a share. Walmart stock traded at almost $30 a share. So if you said Target has the same prospects as Walmart, then you would want to go buy Target. It's on sale, right? It's cheaper. That's what the price earnings ratio is. Dividend yield, that's how much, what we looked at that earlier, right? Dividend yield is how much dividends are stocks paying. Walmart's paying a 1.57% dividend. What does that mean? I mean, dividend yield. That's the annual cash dividends per share divided by the market value per share. So this will change every day as the market value changes. But you'd expect for each share of Walmart you'd expect to get about $2 of dividends. So I'll ask you to calculate dividend yield. And then remember that these values are driven by fair market value, right? A lot of this is driven by fair market value. Fair market value, this volatility, we don't record this in accounting, right? We might find compare ratios against it, but we don't record fair market value in accounting for our own company. We might do it for other investments, which you'll learn in future classes. But for our own company, we're not going to change our equity value. So what's important is to look at our book value compared to the fair market value. And one way to determine the book value per common share, you take the stockholders' equity applicable to the common shares and divide it by the number of common shares outstanding. And so those numbers I can give to you, right? But we can look at a book value and then compare it to our actual fair market value. So that's the end of chapter 11. We talked about equity here. So I'm going to stop here. Is there any questions related to this?